Welcome back to The Explainer. So today we're decoding three pretty wild fintech paradoxes, all from a single day's news cycle, to really get at the unwritten rules of how modern markets actually function. Because as you're going to see, what makes total sense on paper, yeah, it often goes completely out the window on Wall Street.
Like, just think about this for a second. How do you process $100 billion, totally crush your earnings, and still get punished by the market? We're going to start with this exact paradox. We really need to unpack this massive gap between public expectation and Wall Street reality so we can figure out what the market is actually rewarding right now.
Okay, real quick, here's our roadmap for today. We'll start with the paradox hook, then look at buying Wall Street's plumbing with Bullish. After that, we'll dive into the historic guidance trap-catching Shopify, break down a slow-motion restructuring over at PayPal, and finally, wrap it all up with our ultimate takeaway to see exactly what these case studies teach us about market psychology.
All right, let's jump straight into our first case study, buying Wall Street's plumbing. So Bullish, which is a Peter Thiel-backed crypto exchange, just dropped an absolute bombshell. They announced they're acquiring Equiniti for a staggering $4.2 billion. We're talking $2.35 billion in stock, plus taking on $1.85 billion in assumed debt. And look, at a time when most of fintech is playing defense, this isn't some flash-in-the-pan meme stock stunt. This is a deeply foundational, earth-moving kind of play.
To put that crazy number into perspective, that $4.2 billion completely eclipses Coinbase's massive purchase of Deribit. We are officially looking at the single largest crypto-linked deal ever recorded. Ever.
But what did they actually buy for all that cash? Well, Equiniti isn't some flashy, gamified trading app. It's a transfer agent. Now, if you're not familiar, a transfer agent is the legally required nuts and bolts entity that maintains shareholder records for corporate America. They literally support over 20 million verified shareholders across 2,500 public companies.
And just to grasp their massive footprint, Equiniti processes roughly $500 billion in annual payments, $500 billion. They effectively act as the foundational ledger of Wall Street itself. It's unsexy, sure, but it is absolutely 100% essential to how money actually moves.
Led by former New York Stock Exchange President Tom Farley, Bullish didn't just buy a legacy company here. They bought the underlying system of record needed for this huge incoming wave of tokenized equities. Honestly, one source hit the nail on the head, calling this the Kendrick Lamar of fintech M&A. Calculated, precise, and arriving exactly when nobody expected it. They're bringing everything, design, issuance, compliance, trading, all under one roof.
And the financial firepower of this combined entity, it's staggering. Look at these 2026 projections. We're talking $1.3 billion in adjusted revenue, over $500 million in adjusted EBITDA, and a target of 20% annual blockchain growth. While giants like Securitize and Computershare are scrambling to tokenize pieces of the $70 trillion US stock market, Bullish basically just bought the keys to the kingdom. Every tokenized asset is going to need this exact system of record. It completely proves the rule. Infrastructure is king.
Moving right along to our next hidden rule, let's talk about the historic guidance trap. So let's look at the e-commerce giant Shopify. By literally any objective measure, they just posted a monster of a quarter. They became the first e-commerce platform in history to process over $100 billion in gross merchandise volume in a single quarter. Revenue hit $3.17 billion, up 34% and cleanly beating consensus. ShopPay surged 59%, and they kept strong 15% free cash flow margins. Just an incredible scorecard.
But despite hitting that historic $100 billion milestone, Shopify's stock abruptly cratered by 15%. It's like, imagine acing a ridiculously hard exam, getting the absolute highest grade in the class, and your parents still ground you because they expected extra credit. That was Shopify.
The real culprit here? A deceleration in their Q2 guidance. They just printed 34% growth, right? But then they guided for, quote, high 20s, so around 27.5% for Q2. And here's that hidden rule. When you're trading at a forward PE ratio north of 85x, the market has already priced in the absolute perpetual perfection. Any projected slowdown, even a tiny one from an elite baseline, automatically triggers a massive sell-off.
Of course, it didn't help that there were a couple of underlying financial headwinds pouring fuel on the fire. You had rising credit losses in their merchant lending business, plus a GAAP net loss from equity investment markdowns. Combine all that panic, and it pushed the stock down 25% year-to-date.
This quote really sums up the whole dynamic beautifully. Ask Steph Curry how it feels to shoot 45% and lose by 20. That is the high multiple software tax at work. In this harsh environment, breaking historical records just isn't enough to outrun a mediocre guidance line. Guidance isn't just part of the game anymore, it literally is the whole game.
Okay, on to our final case study for the day, a slow-motion restructuring.
Let's turn to PayPal. Once again, we're looking at a super impressive earnings beat across the board. Q1 revenue came in at $8.4 billion, easily beating the $8.05 billion estimate. Adjusted EPS hit $1.34, topping the consensus of $1.27. And this was all backed up by a solid mid-teens acceleration in Venmo and their enterprise payments. Just a remarkably clean beat.
And yet, the stock still fell nearly 9%. So what gives? We have to figure out why the market went out of its way to actively punish a company that easily beat expectations.
Well, the problem here stems entirely from leadership. The new CEO, Enrique Lores, announced a plan to target $1.5 billion in savings by cutting about 20% of PayPal's workforce. That's nearly 4,500 jobs. But he chose to stretch those cuts out over 2 to 3 years. Compare that slow drip approach to competitors like Block and Coinbase. They opted for swift, decisive resets. They ripped off the Band-Aid to immediately clear the air and reset company morale.
To make matters worse, Lores actually admitted on the earnings call that the turnaround plan will, and I quote, take a few months to completely define. Yikes. When you telegraph years of internal uncertainty across thousands of jobs while literally admitting the plan itself isn't even fully baked, you turn what should be a restructuring into a slow-motion flinch. Markets absolutely hate uncertainty. That's not a clear restructuring, that's a rain cloud with no forecast.
All right, bringing it all together now, let's get to the ultimate takeaway.
So, what do these three completely disconnected events from a single day teach us? We've uncovered three crucial hidden rules. First, unsexy infrastructure rules the future. Bullish buying Wall Street's plumbing? Total masterstroke for the future of tokenized assets. Second, forward guidance matters way more than past perfection. A historic $100 billion quarter is basically worthless to the market if it comes with decelerating guidance. And third, beating earnings cannot mask leadership indecision. A drawn-out, undefined restructuring plan, yeah, that's going to ruin an earnings beat every single time.
So knowing these hidden rules now, how differently will you evaluate the infrastructure plays and the future guidance of the companies currently sitting right there in your brokerage app? I'm going to leave you with that question to help you fundamentally rethink how you look at the headlines the next time you open your portfolio. Thanks so much for hanging out with me on this explainer, and as always, keep learning.